now. In today's webinar, we'll be discussing COMEX Gold trading on the Nova platform. Before we begin, I'd like to do a sound check. If you can hear me, just type yes in the question box. During the webinar, if you have any questions, do type them up in the question box as well, and I will address them at the end of the whole webinar. Okay, it looks like everyone can hear me. So let's begin tonight's webinar. Before we start, just an introduction of myself. My name is Phil Gunn, the speaker for this webinar, and I've been with Philip Nova for 18 years now, since 2008. I hold a dual license in futures and stocks, and I'm account manager to help clients trading in futures, forex, as well as shares with understanding the product and market by providing coaching sessions and economic information to make proper trading decisions. Following a historic 2025, we have seen gold prices surge by approximately 65%. The precious metals market has entered 2026 now with strong momentum. We see spot gold has recently tested the $5,000 per ounce milestone, with some major financial institutions having projecting potential targets approaching $6,000 an ounce. With the volatility increasing alongside bullish sentiment, traders are now asking whether the rally still has room to run or if the market may be approaching a potential bull trend. We'll look at both the macro and technical outlook for gold in today's session and discuss on how you can add the gold into your portfolio for investment or for speculation. Throughout the webinar, as mentioned, if you have any questions, feel free to post them in the question box. My facilitator will arrange them and let me know, and I'll answer all of them at the end of the session. This webinar itself will also be put up on YouTube after today for you to revisit if you wish to do so. Okay, without further ado, let's get right into it. Just a disclaimer before we start. Materials provided here is for general information and does not constitute a recommendation or solicitation to trade. A brief outline of the webinar today. So today's webinar, we'll start off with a macro outlook for gold. Looking at the past movement, we'll be setting a perspective of the trend for the past 6 months. We'll be discussing what has been the fundamental forces that's been driving the rally and other events that have sparked the volatile swings in the market. Based on these factors, we'll project a technical outlook for gold. Next, we'll move on to explaining how you can use the COMEX Gold Futures to trade on the gold price, which gives you more control over the gold price, done in a controlled sizing with flexible exposure. Lastly, we also do a trading platform walkthrough on the Nova platform. So let's now look at the gold movement for the past 6 months. The past 6 months has been historic for gold market, characterized by a breakout to unprecedented psychological levels. As of today, gold has transitioned from a steady climber to a highly volatile asset, recently just crossing the $5,000 an ounce threshold. The last half year has seen gold move from approximately $3,600 an ounce back in September 2025 to current spot price hovering just above the $5,000 mark as we speak. Here's the detailed movement breakdown shown on the chart here. We can see starting from the price range in September to October of 2025, the price range was from $3,600 to $4,300 an ounce. This period marked the end of the $2,000 an ounce era. So gold broke through the long-standing psychological ceiling of $4,000 an ounce in October. Factors driving this breakout was firstly due to tariff shocks that was imposed by the US administration. New global trade tensions emerged with the implementation of aggressive US tariff proposals, which created massive uncertainty in equity markets. Because of the uncertainty, there were large ETF inflows. Institutional investors who had been cautious began aggressive buying of gold in fear of missing out on the movement. The gold share of global financial assets also increased towards 3% of the portfolio. There was also currency diversion. Emerging market central banks accelerated their pivot away from USD-denominated assets after a series of sovereign credit downgrades. So after October, the breakout from November to December 2025 came in place, where the market went into consolidation and structural support. The market spent about 2 months during this time building a floor above the $4,000 an ounce, with the price range ranging from $4,000 an ounce to $4,500 an ounce. At this time, the Federal Reserve started to pivot and said there was anticipation of year-end rate cuts, which materialized at 25 basis points. This lowered the opportunity cost of holding gold and provided more impetus for the upside. There was also year-end rebalancing as usual every end of the year, as large pension funds and sovereign wealth funds increased their gold allocations as a bedrock for things. There were debt ceiling concerns as well, as renewed threats of a US government shutdown back in October had provided a safety bit that lingered into the holiday Christmas season. Then after, we experienced the meltdown or parabolic surge. Actually, the surge came first and then there was a meltdown. So gold went into a blow-off phase as we see gold prices start exploding to an all-time high of $5,595 an ounce on January this year, before a violent technical correction which soon ensued after. The price range was $4,500 an ounce to $5,595 from January to February. This movement was driven by speculative mania, as many retail investors who, after seeing news of the gold price movement, started buying both in the physical market as well as the futures market in speculation, and algorithmic trading also pushed the price to unsustainable levels just in less than 30 days. As the prices reach extreme highs, profit-taking sets in. We see large investment banks like JP Morgan and UBS signaling that the market was overextended. Soon after, this triggered a 50% sell-off as the traders cash out and take profit. The price of gold soon corrected to $4,400 an ounce. So on the central bank front, there was also a pause in central bank buying as the buying mania started to creep in. So the World Gold Council reported that the central bank buying in January slowed down by 80%, which is a huge drop. As central bank buyers are the biggest buyers, this actually affected the correction as well. We also see reserve managers waiting for this parabolic spike to cool down before entering the market. Moving on to the time right now in March, we are now at the war premium consolidation period. So things have actually quietened down a lot, and we have stopped seeing the crazy rally of the gold prices. The price range as of now is from 5,000 psychological floor to the $5,300 broad level. Gold has stabilized after the January crash, finding a new equilibrium just above the $5,000 mark. So the key drivers that assist in this quick recovery after the crash is mainly due to a few reasons. Firstly, is the Iran-Israel war. The escalation of strikes in late February, just 2 weeks ago, and is still ongoing now, has reintroduced a heavy geopolitical risk premium and setting the gold as a safe haven in the long term. Secondly, for the war itself, this caused an oil-driven inflation. So with Brent crude prices spiking over 15% due to Middle East tensions, gold is now being used as a classic inflation hedge. Next, the $5,000 floor, which is a major psychological level, has now transitioned from a target of critical support zone As long as this number holds, the long-term trend still remains bullish. So this is the movement for the past 6 months. We will now move on to what are the events that actually drive this movement. There are several high-impact developments that converge to drive this unprecedented rally. First, we see the geopolitical escalation in Iran-Israel. The recent strikes in the Middle East have significantly reignited the war premium. Concerns over the closure of the Strait of Hormuz have sent both oil and gold higher as investors seek safety. Next, the de-fiatization trend. Beyond the simple de-dollarization, 2025 saw a broader movement where investors and central banks, led by Poland, China, and India, moved into gold to hedge against the debasement of all the fiat currencies due to rising global debt. In short, there was a movement away from US dollar as well as other currencies to safe haven of the gold. Thirdly, there was monetary policy and Fed uncertainty. Throughout late 2025, US Federal Reserve's series of rate cuts, including the one in December 2025, lowered the opportunity cost of holding non-yielding gold. So more recently, a criminal probe into Fed Chair Jerome Powell and political pressure for lower rates have fueled the debasement fears. Next, we have the trade tariffs, of course, that's causing the volatility. Uncertainty surrounding international trades relations and 25 acted as a catalyst away from risk assets and into the bullion market. Lastly, for the correction, it was a profit-taking correction. A major market event in late January triggered a sharp sell-off of 15% reversal, showing that in all markets, when prices overextend, speculative bubbles still can burst, even in a very strong bull market. So, having understand the events that caused the movement, let us just revisit what are the fundamentals, that's landscape that the gold is actually encountering right now. So it has moved from a hedge market to a cornerstone asset. Gold itself is in a structural bull market, as we see it's constantly making high highs. Over the past years, we have seen since 2008. Although price reached historic peaks near $5,600 an ounce in January, the current period is defined by a more mature structural shift in demand rather than pure speculation. In January 2026, the slowdown for the central banks reported a net purchase of only 5 tons in January. As mentioned, this is an 80% drop from the 2025 monthly average of 27 tons. This is viewed as a price-sensitive pause rather than a reversal of prices. As we see, reserve managers temporarily pull back on the buying as gold went parabolic towards $5,500. So after this, now we are seeing leading buyers coming in. Despite the pause, China has now extended its buying streak to 16 consecutive months, and Uzbekistan also added 9 tons in January alone. We also see new central banks coming into the market and resuming buying of gold. For example, Malaysia was a new name among the new gold purchasers, having bought 3 tons in January, its first increase since 2018. While also for Bank of Korea, they're also looking to resume their gold investments for the first time since 2013. To see more in detail where the gold purchasing has moved into, in 2026, the primary driver of price momentum has shifted from physical buying of gold to institutional buying of gold through ETFs. So we also see year-to-date inflows of global gold-backed ETFs registered their stronger 2-month start to a year in 2026, adding $5.3 billion in February alone. This record AUM is driven by the price surge Total global assets under management for gold ETFs hit a record of $701 billion in March 2026. In this emerging trend, we see a historic shift. The Bank of Korea announced in Q1 of this year that it will begin incorporating physical gold ETFs into its official foreign reserves, citing better liquidity than traditional just pure physical bullion bars. Of course, we still have to touch on the physical demand for gold itself through jewelry, bars, and coins. It is currently facing a price tag shock where the price is too high for retail buyers of jewelry, but still remains fundamentally supported in the eastern markets of Asia. The 2026 forecast, annual bar and coin demand is projected to exceed 1,200 tons globally in 2026, which is still remaining strong. And we see that China and India, the biggest two countries in traditional jewelry demand, has softened roughly 10 to 15% due to the high price point right now. The Iran-Israel conflict also triggered a localized surge in physical buying in the Middle East and Asia as a safe haven and a hedge against currency collapse of their own country because of the regional war that's ongoing. Gold is no longer just expensive. It is being fundamentally repriced for the world of high debt and geopolitical fragmentation. The $5,000 floor is currently being tested. If it holds true much, this confirms a new permanent valuation of gold and a new era for this metal. So the fundamentals for gold still remains very strong and has shifted into more of a cornerstone right now. Next, we look at other factors that affect gold moving forward. So following the joint US-Israel attack on Iran on February of 28 this year, both assets saw an immediate war premium. I'm referring to oil and gold prices. So for crude oil, it spiked nearly 15% this week, with Brent crude reaching $83 per barrel and WTI crude oil hitting $79 per barrel. Due to the closure of Strait of Hormuz, it has since moved even higher in the $95 per barrel range. So for gold, this gap up initially to $5,390 an ounce on March the 2nd, but it since has failed to hold above the pivot and has now moved down on a retracement to test the $5,000 per ounce level. We'll later on move to analyze whether the technical outlook for gold price in the next few slides. But before that, let's look at whether gold is still an inflation hedge and if it's still under pressure. Typically, when we talk about higher oil prices, that's higher inflation. And this actually means bullish for gold. But this is different right now because in the current environment, there are two factors that are dampening this effect. First is the rate cut erosion. Markets are beginning to price up previously expected interest rate cuts. So if oil stays above $80 per barrel, it adds roughly 0.5 percentage points to the global inflation. This makes central banks like the Fed more hawkish, less likely to cut interest rates moving on, and keeping the rates high for longer. This pushes bond yields higher, making non-yield gold assets less attractive by comparison. So there's also a safe haven currency competition with the dollar. The US dollar or dollar index is also acting as a safe haven during this war. We are seeing a stronger dollar, which makes gold more expensive for foreign buyers, capping the upside that the inflation hedge narrative would otherwise provide. It was also noted that during the market sell-off, such as equities in the stock market of the US market, investors sometimes sell gold to raise cash to cover their losses in their other assets, causing a temporary safe haven failures. So you can see gold prices actually move in tandem with the stock indices in the initial stage as the stock market takes a deep correction. but it will slowly pick itself back up in the medium to long term. Right, we have actually covered the fundamental analysis for gold itself. We'll now move on to the technical analysis for gold. So spot gold is actually exhibiting a classic consolidation following a parabolic move right now. As mentioned, the strong momentum has subsided and we are now in consolidation phase. After testing the all-time high near $5,400 to $5,500 earlier in this month, the metal is currently navigating a corrective phase as it balances extreme geopolitical risk against a hawkish Federal Reserve. In the long term, it is still firmly bullish, but the price range is now ranging from $4,878 to $5,415 an ounce, with a psychological floor, of course, and mentioned at 5,000, which serves as a critical structural support. I would see the 4,800 serves as a good value buy if it does reach that level. However, it does not mean it will actually break through the 5,000 psychological level. So, first possible scenario is a bullish one. If there's a further escalation in the Middle East or energy supply disruptions become really serious in the Strait of Hormuz, gold will ignore the strong dollar and push past $5,415. And if it holds above this level for a weekly close, we can see the technical path is open toward testing of the higher highs of $5,500 to $5,600 within weeks. The probability of this is still high given the current intensity, and it really depends on how the events on the oil unfolds. The second possible scenario is what we are encountering right now. So it's a neutral to a bearish scenario. The consolidation will drag out around the current fair value of $5,124 an ounce. This is the pivot where trading above this will favor more buyers coming to the market to bring it to a higher high. However, right now we are testing the $5,000 level, and Iran has failed to threaten the supply of oil through the Hormuz so far. So if US economic data is coming too hot also, pushing the Federal Reserve to delay further rate cuts expectations further into the late 2026, this could result in an even stronger dollar. So the outlook for this will actually be a period of distribution where gold fails to reclaim $5,200 level and drift back to test the immediate support now of the $5,000 level. And if this $5,000 level fails, we can see a rapid flush out towards 4,850, which I reckon that would be a very quick one and a strong rebound from there. So for probability of this happening is moderate, pretty high still at about 40%, and it is actually ongoing at the moment. So this is the technical outlook for gold. In short, we are in consolidation phase, and a range trading strategy will be encouraged. And for a range trading strategy, it's not really advisable for a long-term holding of gold. Yeah, fair value is about $4,800, and if you're a long-term investor, entering the market at that 4,800 level with sufficient funds to hold through the volatility is still quite a good investment to add this into a portfolio. However, if you're going for short-term trading, one would think that a day-to-day cash out on position would be a advisable strategy as we are in a range market. Now move on to how you can incorporate the COMEX Gold contract to your portfolio. So there are many options out there. And today we'll be covering how you can use the COMEX Gold Futures, which is a very cost-effective method to trade on the gold, on sensitive gold pricing, rather than using other methods like the ETFs, which can only be traded during the exchange trading hours. And also you can use the COMEX Gold Futures to go on the short side, meaning you can do a short sell if you think it's changing a range right now. You can actually sell the top of the range and buy back when the price is low to make a profit. And you might think that this is actually a very risky product, but it has actually changed a lot for the retail investors. And now we are down to the 1 ounce COMEX gold sizing, which is a very, very safe, the smallest you can get contract that to buy the gold itself. So this contract is only 1 ounce and it's financially settled, so there's no delivery. And this is actually also a bi-monthly contract. So we are talking about the February, April, June, August, and October month. Right? There's no interest charges for COMEX Gold, unlike spot gold. If you're trading over the counter using trading local London gold, you'll be paying interest or swaps, which is quite expensive. So for long-term wise, it is more cost beneficial to use the COMEX Gold Futures to speculate or hold for long-term positions. So trading is from Mondays to Saturday, starting from Monday 5 a.m. or to Saturday 4 p.m. And coming to the end of the expiry, last trading day, you have to liquidate the position, or you can actually adopt a position in a further month, maybe in the April. Now it's April, you can adopt a position in the June or the August month. Yeah, so you can simply just roll over your position when the expiry date approaches, and we'll also send you a reminder via email to do so. As mentioned, there's no other cost except for the rollover, which is the closing of the current month position and opening a new position in the following month. Okay, now we are doing some examples on the calculation of trades of the COMEX Gold Futures. Shown here is the calculation of the gold futures trades. In this example, the gold price is showing as 5,383.5 bit versus 5,384 ounce price. So the contract size is just 1 ounce COMEX gold, and the initial margin on the funds required is $538 US. This was based on the old 9.9%. Currently, yes, actually, the volatility has subsided, and the COMEX exchange changes to 7.7%. So an update on it, if the gold price is at $5,000, a 7.7% would mean a $385 for one lot of 1 ounce gold is required only. So for this is updated to $385 per contract. And this gives you about just over 10 times the average. To be exact, it's 100 divided by 7.7%. It's a 13 times the average. So the smallest tick movement is 0.25, and it equates to 25 cents on the US dollar. To make it simpler, every dollar movement, because it's a 1 ounce contract, is a dollar gain or loss, depending on the direction of market that you enter. So with just $358, you can start with one contract in the 1 ounce. So assuming that we buy one lot of 1 ounce COMEX Gold Futures at $5,384 as shown, right? And then the market moves $10 upwards within the day itself to 5,394. And you decided to take profit. So you sell at this price of 5,394. You have actually seen a movement of $10 in the price of gold per ounce. And that would mean that's a $10 profit that you're making. So your account will have an additional of $10. And then you have to deduct the transaction cost for buying and selling. A round trip, that would be about $1.90. And that would be the profit. So this is a simple calculation for a positive, profitable trade in the 1 ounce COMEX Gold Futures. Next, we are looking at one loss example here. So using the same price at 5,383.5 and 5,384, we also sell at $5,384 per contract. But right now, instead of just 300 and 530, let's just use this example, 530, and we have $600 excess funds, $600 in account, meaning we have an excess fund of $62. So if we buy one lot of COMEX Gold at 5,384, and the settlement price is at 5,324, we have not closed out the position, but the COMEX Gold Futures is marked to the market based on the settlement price every day at the end of the trading hours. So this is actually a drop in from 5,384 to 5,324 is a drop of 60 points, meaning to say we have an unrealized loss of $60 since we have not closed out the position. And the funds in the account was $600. So with this unrealized loss of $60, 600 minus 60 gives you $540, which is still above the margin required of $538, just for example, for the margin, since the margin was adjusted already. So there will be no margin call, although there's a realized loss. So in this example, you can see that we have actually came in with extra funds, $600, instead of just enough funds of 538 to sustain the movement in one day for the gold price to drop $60. Right, of course, this is in a stable environment where the gold actually moves $60 per day. But recent months, we see gold movement can actually move from $100 per day to $300 per day when it was crashing. So excess funds is advisable when you're trading one lot size. So typically we use about a quarter of the funds, or 25%. Means say if you have $2,000, you can start off one control to ensure that you sustain the whole movement if you're going for a long-term position. So it's advisable not to use all your funds in one trade, but giving excess funds so that you can sustain the volatility. As shown in this example where there was excess funds and the position was maintained. Next, we look at an example where we do not have enough funds to sustain. So using the same example, the initial margin is still remaining the same at 538. And now the count in the funds is still remaining at $600. However, we have bought at 5,384, and at the end of the day, instead of dropping just 60 points, it dropped to 5,284, a difference of 100 points movement. This means that we have unrealized loss of $100. So the amount of funds in the account drops from $600 minus 100 down to $500. And this is less than the margin required to enter one lot. And a margin call is triggered. You have up to 2 days to top up to meet the margin call, else the position will be liquidated. So this is a scenario of a margin call if you have insufficient funds to hold the position. As long as you hold the position with sufficient funds, the unrealized loss can still turn into positive, and you can close out the position when the market bounces back up. I hope you're following so far. Right now, we'll move on to the demonstration on the Philip Nova platform. So if you're interested in the demo platform, you can also sign up for it to take a look at how the platform displays the live price and so forth. The Philip Nova platform is a multi-asset class platform with different products that's available, talking about stocks, ETFs, futures, Forex, CFDs, all in one platform. And you can actually trade this on your mobile phone as well, as we also have a Nova app. The chart we use is actually TradingView, which I'll show you later. And you can see that all the products are actually categorized according to asset class in the watch list over here. To start off, this is the demo account, as shown by the orange color. and the demo word here. Right, so we have different products that we can add in. We have a couple of ETFs here, mainly the indices ETFs from US market as well as the Singapore ETFs. I've just added in the COMEX Gold. This is the 100-ounce contract, trading at about 5,010.6. Just an indicator, this is not the actual price itself. It may be a delay in the price. So to add the symbols to the watch list, you can click on add symbols over here, and then you'll see it by product category type, futures or forex or CFDs or stocks, right? So for this case, we also have the spot metal over here if you want, but that will mean that you'll be paying interest. So I would recommend you to actually use the COMEX Gold Futures, since the transactional cost is also very cheap. So click on futures. The gold futures is actually located under the COMEX Gold Exchange in the US. So we will expand that. And for the 1 ounce gold will be indicated as 1 ounce gold, but over here, because it's a demo account, we're only showing you the 100-ounce gold contract. As you expand this, you'll see that there's an ACT, means the active contract. Currently, active contract is April, and it will be expiring soon, coming the 28th of March. Yeah, and you can also select individual contracts. For example, if you want to select June or August, you can do so and add them. As an example, I'll just double click on it. And once it's selected, the heart shape will be filled, and you can see the contract has already been added over here. So trading a further month is, of course, a different price compared to the actual price. It's not showing here because it's a demo account, but it moves in tandem according to the price movement. But do take note that the spread might change according to the longer term view of the gold market itself. So besides futures, we have other products that you can add in. We're seeing ETF over here. You can also add on stocks if you want to. For stocks, it's all prepaid, and you can select the exchange that you want to trade on. For example, you can even search for the stock itself straight away. Yeah, but the demo account does not have it yet. So you can add it in when you open the account, and all these live prices are actually free for access, right? So you can right click on the contract name and select contract spec over here. This shows the information of the contract. So what is the contract size? This is the 100-ounce regular size. You can trade as low as 1 ounce contract. So that will be a different ticker symbol that we're showing. And from here, you can get information on when is the last trading day that you need to get out the position by, right? So for the COMEX 100 Gold Futures, because it's a physical contract, we need to close out to avoid delivery. Unlike the 1 ounce contract, which is cash settled, you do not have to worry. So the last day for this is actually it's not shown correctly, yeah, but yeah, you can get the information when you have the account, and it will show you the correct dates. So this is the first step to add the contract into the watch list. After you have done that, you can go to place order to get access to the order menu. So from here, if you want to place an order, as you can see, double check on the contract itself, as this demo is delayed price. There's a buy and sell button which you can alternate. So if you think that the market is coming down, you can also short sell the market, right? And the quantity is shown here. Just input the quantity. Default is 1. Order type, you can go by limit order or market order. Limit order is to queue for the price that you want to enter, and market order is to execute straight at market price. I always advise to use the limit order, even if you want to do it at market price. Simply just input the market price. For example, if the market price is 5012, you can just change it to 5012.6 as shown as the market price, and submit this way so that you can get the price that you actually see on the screen and avoid slippages. Right. So after you've done all this, you click on submit. It will not be executed though. There'll be a confirmation screen, and you just double check all your information as a good habit and submit. Right, so as I mentioned, it's not it will not be actually did enter. Okay, so currently you have entered one position of the COMEX Gold April, and the price was 5011.7, right? And you can see there's a current unrealized profit of $20 based on the last time price of 5011.5. I have actually also a working order over here, which I submitted earlier before this webinar session. So taking this example, you can amend any working orders by clicking on the icon here, the amend button. Right, so you change your mind, don't want to buy at 4,950, you can change it to $4,900, for example, and then you click on amend. So just to confirm again, you're amending from 4,950 to 4,900, confirm amend, and the price is amended to $4,900, and there's a pop-up message that shows you. Okay, if you want to cancel any working orders, you can do so also by clicking the cancel button over here, and the order will be removed. To close the position, this is by a first in, first out system. So currently you have a long position. To close out this position, you need to submit a sell order in the same way in which you submitted this order for this position. So we'll double click from here again to open the place order, or right click and place order. And then we select the sell, which is the opposite direction of the entry position, which is a long, a +1, a buy position. So we have just to queue for a limit order at a higher price, maybe at 5,020, and submit. And then click on confirm sell. Okay, once you have submitted, I made a double submission, I will delete it. You'll see under the working orders tab to sell one lot at 5,020. So when this order is done at this price, it will match with this order over here and close out the position with for a profit. So that's how you can actually close out position. Now you may be wondering, how about stop loss? You can also submit stop loss orders for the position. And you can also submit our OCO order, which one cancel the other order. This option is not available on the demo account, but will be available on the live trading platform, when you can simultaneously submit a stop loss and a take profit order at the same time to ensure that you get out of the position when one of the prices hits. So this protects your position from Mondays to Saturdays. Take note that Saturday, Sunday, the markets are closed. So any events that happen and affecting the price opening on Monday will cause a breach and the order may not be executed. I mean, a gap in the prices when the market gap opens on Monday and the order itself may not be executed. Right, this is how you actually place the orders and monitor your positions over in the various tabs. So we have the open position tab. When the orders are completed, it will all be shown here, whether they cancel or all failed order types. And then we have the working order tab as well. And from here, you can also have other services accessible straight from here, including notifications and for information on products or on the market. We will all send it through the system itself. And you can actually, as this is a multi-asset currency, you can do currency conversion on your own. Withdrawal also can be submitted using this platform right away. And you can view your statement for all trade done. The statement will be sent to you via the system or an email as well, where you can refer to all the trades that's been done on a daily basis. So for fund deposit, you can generate a QR code from here for easy transfer of funds into the account. So we accept via PayNow, where you can deposit funds right away and receive usually credit within 5 minutes of doing the PayNow. For fund withdrawal, it will be processed at the cutoff time at 11 o'clock. And you'll be getting on the same day for local bank withdrawals by the evening time latest on the same day. So next, I will just cover on the charts, a quick show of the charts over here. So to open the chart, you can just simply right click and click on chart over here. And to expand it further, you can actually click on the expand screen. So there's two tabs for two same charts. I'll close one of them. And then over here, I'll expand this up. You can see a bigger view of this chart. All right, you can also trigger the trade manage from here, but this is the second method that you want when you can use it. If not, the charts are used by using the trading view chart. So whatever you see, indicators are also available itself. So you can just it's a very good chart platform that can be used. So we have different time frames as well that you can choose from. And lastly, this is the amount of funds you have in an account, right? So this is in terms of various currencies, but this is just an indicative value of the funds in an account denominated in this currency, but does not mean that you actually have converted the funds into this currency. So to actually know how much funds you have in each of this currency, which you can manage through the currency conversion, this will be shown inside there, currency conversion tab. You'll be able to see all the funds that you have in each of the individual currency for the live account. So we start out with a larger balance, and if you close out any positions with profit, it will be shown as realized profit. Currently, we have an open position, and the position is on an unrealized loss. Profit and loss, it will be showing that as unrealized loss, right? So yeah, you can change the color of this minus 100 to red if you prefer. Yeah. So anyway, when there's a negative number in the buying power over here, right, for the futures products, this means that the margin call will be in effect, and you have up to 2 days to do the margin call. And so this is how you monitor the fund status to ensure that this number is a positive number so that your position can be maintained. Of course, I'll explain in detail to you if you have further questions about this monitoring of funds. And that's on the platform demonstration. So I mentioned earlier that Philinova offers a one-stop platform to trade across different multiple assets, including stocks, futures, and forex. You can trade on the go with the Nova Trading app as well on your smartphone, as well as the PC, desktop, tablet devices. Enjoy the chart powered by the Trading View, and you get access to over 100 technical indicators, market depth, and also view the liquidity and trades for each particular price in the market easily. And all this, there's no maintenance fees, and you can monitor your trades wherever you are, whenever you want. So something to add is my personal services. We have a dedicated AE that will be assisting you on your account at no extra charges. So I'm a dual license holder specializing in futures, forex, and stocks. I offer services such as providing economic data updates through WhatsApp and trading advice that you may have. You can ask me any questions on trade matters, and personalized coaching programs tailored for traders from novice to intermediate levels. We can deliver these coaching sessions through online or in person at our office at Raffles City Tower. So apart from coaching, I also provide my clients with practical tips on managing risk effectively to avoid overexposure in their positions. Based on the market trends, I conduct regular webinars like today and enjoy sharing these market insights and trade ideas with fellow passionate investors like yourself. If you're interested in having a trading coach or find my services suitable, simply scan the QR code right here to secure a free one-to-one coaching session. During a session, I'll cover technical analysis and demonstrate strategies using our Philinova platform. So sign up for the live trading account. It will only take a few minutes using your SingPass account. There's no minimum deposit required. Here is the coaching QR code. So effective trading requires access to information on markets and discipline in the execution of such trades. It's good to have your own personal mentor or AEs especially for traders who have just embarked on their trading journey. So for seasoned traders, you can also expect prompt service on my part on queries pertaining to your trades, as well as any queries according to your trading account matters. So if you are new to trading, you can sign up for the coaching, where your queries about trading will be answered. During the session, I will introduce basic technical analysis that is fundamental to make decisions on your entry and exit levels for each of your trades. To find out more, just scan the QR code to sign up for the one-to-one coaching session. This can be delivered, as I mentioned, through online or at our office at Raffles City Tower. Right. If you sign up a live trading account, we also have the trading research central research portal, where our in-house analysts email the technical reports directly to you on the suggested levels for your reference. This will also be delivered through the notifications in the Nova platform as well. This will be on the suggested entry and exit levels for your consideration. It will be sent via NATE titled Daily Trading Highlights, showing directional views from our global research desk. These are the good starting points for your own research to identify the opportunities that make sense for you. Markets include the following: the Dow Jones, the Nasdaq index, the S&P, the Nikkei, the SGX FTSE China A50, the Singapore SIMSCI, the crude oil, Hang Seng, and of course gold and silver and other precious metals. So besides that, we also have the daily commentaries. For fundamental, we have it covered with commentary reports to give you updates on the economic news that's happening around the world, to keep you updated on any events that may have a potential impact on the markets, saving you the work of searching for it, and you promptly notified when such an event happens. So we provide the fundamental as well as the technical aspects of trading information to you, and you can have a platform ready to enter the market wherever you are ready. Besides the analyst reports, you can also reach out to me with questions about technical views on the trades that you may have. I'd like to do a shout out for the COMEX Gold 1 ounce futures right here. So this contract is suitable for all new retail investors, considering the size of the contract being so small. Get started for as low as for the COM is only 68 cents COM plus 27 cents all in USD for the exchange fees. This is a combined total of 95 cents per USD per trade. So this means that a round trip will be less than $2, and you can start trading with such a low price point compared to trading on ETFs, where you may actually pay on the actual commission based on stocks rate. So there are also other contract sizes like the 10 ounce beside this 1 ounce and 100 ounce regular contract size. But this is a good place to start for new investors on the gold contract, be it in a long-term sense or a short-term speculation sense. So you can trade on smaller contracts like the 1 ounce first. We also have to control the risk exposure to the contract sizing. And we also have silver contracts also. Now we have introduced, the exchange has introduced new 100 ounce silver contracts, which are very comfortable place to start with for those interested in these silver. So besides buying physical gold or silver or ETF, you can try trading on the COMEX Gold or COMEX Silver, which is very price sensitive and have very quick access to exit and enter the market at a very low cost price point. So this is an alternative product which has been around for many, many years already. It's flexible, it's cost efficient, and you can control your exposure to trading gold and silver. So you can sign up across these contracts just by using the online account opening link provided in the next slide. So simply just sign up for the free account opening now using this QR code. With this QR code, I'll be servicing your account, and with the low transaction rates, you gain exposure to a cost-effective round-the-clock trading using the COMEX futures. Exposure, as mentioned, is as low as 1 ounce, and that's the lowest you can get. There are absolutely no platform fees or maintenance fees. So just sign up with this QR code. I'll be assisting you on your account matters, and you have a dedicated servicing AE on your trading account. I look forward to onboarding you on this trading journey. We have not come to the question and answer Q&A session. So let's try to answer some questions if we have some. Okay, questions from Kelvin. The notional value for one contract of 1 ounce is the same as the price of 1 ounce, which is around 5,000 now. Don't quite understand your question here, but the margin, okay, for 1 ounce contract, the notional value for 1 ounce contract is actually the price that you see. So for example, right now, when you refer to the platform, you can see the price as 5,011. That is the notional contract value. So because you're buying 1 ounce per contract, 1 ounce is 5,1130, for example. And then you do not come out with 5,011, you only come out with 7.7% of this amount. And it's marked to day and every day. So it's a price increase, the margin requirement is higher. So notional value is 5,011 for 1 ounce. For the 10 ounce, will be 10 times of this will be 50,000. And for the biggest contract, regular size will be 100 times this, which is a 500,000 contract size. Yeah. So I hope that answers your question on notional value, but margin is based on 7.7% of the notional value. I hope that makes sense. So another question from JJ. I see that the 10 and 20 EMA did a death cross on the daily charts today. So based on that, we are still as bearish right now, right now. Yeah, you are using a very small time frame, small 10 and 20 EMA. So I would still recommend you to take a bigger look at the 50 or even the 200 EMA. So let's take a look if you want. So yes, that is why we have said, because of the crossing, I want to call it a death cross, but it's a definite loss in momentum. Hence, as we have now entered a different stage where we are no longer having a strong buying momentum. So over here, let's just put in the ENA for 50 and then 200 on. So for 50 is this one. You can see that gold prices has by the 50 EMA. So the uptrend is still intact, right? So I would not consider the crossing of your 10 and 20 EMA as an indication of a downtrend yet, but it's definitely a loss we've seen that has breached the trend line over here. So I'll just draw a quick one. We are doing a bit of technical analysis here. So on the daily chart, we can see that is why there's the crossing, because the trend line has been breached. And this is why I say there's a drop in momentum. And we'll be seeing a consolidation in this area over here. And the support line is over here. So this is the big range support from here to here. I'll just draw that in as well. Okay. So just quick draw of the range, you can put in. So this is possible, right now, because the psychological level of 5,000 is trying very hard to hold over here. So many scenarios can happen for a consolidation. You can actually go back and test and fail to break and then go for a deeper and test here. That's one scenario, or consolidation. Or you can just, for a very extended period of time, stay in this range of 5,000 to this $5,200 with a pivot of 5,120 in the middle line, in the middle of this small range. And this range will keep on going and tightening as we move along. And then suddenly one day it will take a direction, maybe a false direction, and swing the other way. Who knows? But it will take a direction and we'll embark on the next movement onwards. So fundamentally, it's very supported. As I mentioned, central bank buying has resumed and will resume, and there are support. We see a very huge buying by institutional ETFs at $4,800 price point, which is around here, right? 4,870, 4,800. So it's still a good buy in the long term. As we can see, over many years, the trend has always been uptrend, and it will still continue to be so because we have a lot of buying from all different levels, from central banks, from institutional investors, from physical buying. So doing a consolidation right now, and it's something that you can add to your portfolio if prices dip. All right, moving on. Another question for Kelvin. I find that only four chart and 4 that can be open at one time. Can you display a few simultaneously? Just facilitate multi-contract debt trading and multi-chart analysis. I believe you can open quite a few. I have not tried them out myself, but it may slow down the display. So you can actually, and also the display size, I'm not sure you can display more than 4 even on the PC. You can imagine if you open up 4 different charts on the same chart. Yeah, you can drag it out definitely, and try to line them up. But you can see if you imagine 4 of these, they will already cover your screen. So I'm not sure whether be effective will display. But no problem. If you need help with that, we can actually can assist you on how to set up this more than 4. Yeah, but I believe you can do so. Yeah. I have to check again on that one. So another question from JJ, what's the minimum size for physical delivery of the gold contract? You decide if you want to. Okay, so we don't do delivery at all, but to find out more on this, we can actually talk about this one because different contracts have different characteristics, even on the same product itself. So as we know, COMEX Gold, there are different contract sizes. We have the 1 ounce contract, the 10-ounce contract, and the 100-ounce contract. So each of these contracts, right, have different characteristics. The 1 ounce is cash settle, the 100-ounce is delivery. So the mechanism is different, but whatever the mechanism is, it will always have to be either close off or cash settle. So we do not do any physical delivery. I can explain more in detail with you if you want through WhatsApp. You have my number later on the slides. So another question, is that maintenance fee imposed or is that platform fee? Yeah, as I mentioned, all this you see right here is all free. You can simply just sign up for the live account. Access will be granted if you pass the CAR, which can assist you with the online quiz, also with all the answers. But of course, I will explain to you the exposure of the futures and how to trade on it if you are the new beginner in this matter itself. But the COMEX Gold Futures is actually a very retail investor friendly product right now. So many may have heard that the futures trading is very risky, high exposure risk, but this actually really depends on your risk exposure. So with this very small contract of 1 ounce, the movement is really very small per day. The maximum you can lose if it's a $300 drop is $300 itself. So depends on how big you play. It will depend on how risky you will be exposed to. So, and the cost for each trade is very little. And I would think that is actually a very good product, be it for long-term investment or speculation purposes. So why not just sign up for the live account and try it out and look at the prices? You can also sign up for a demo account if you want to get a feel of the platform and the charts itself. So let's see if we have any other further questions. Okay, if not, that's all the time we have for today. So thank you so much for all the questions and being such a good audience. Feel free to drop me a message or email me if you have any queries. And thank you for being such a wonderful audience. Some of you may have messaged me as well. I will take the time to look at it tomorrow and reply you individually to all these messages. You may be interested in a coaching or have other further questions. Just drop me a WhatsApp message even before starting off the demo account. I'll be most willing to help you. So once again, thank you so much for attending the session. The link to this recording will be made available in our follow-up email tomorrow or maybe after tomorrow. If you have any queries on this webinar or would like to get started, simply reply to our email and we'll get in touch with you. So this is Phil again. Have a good evening ahead.